economy was in the longest expansion on record before the COVID-19 pandemic. But a sharp decline in economic activity is now inevitable, with unemployment insurance claims skyrocketing, and many forecasters saying that the economy, frankly, has already entered a recession. The federal government has a wide array of available policy tools to keep this and future downturns as short as possible. I'd like to explore one of these policy tools, open market asset purchases, with you. And we can explore others over the next few weeks. Interest rates are under the control of the Federal Reserve, also called the U.S. Central Bank. And during a recession, unemployment rises and prices sometimes fall in a process known as deflation. Unfortunately, the Federal Reserve has already exhausted much of the room it had for its standard approach to cutting short-term interest rates to offset an economic downturn and stimulate a recovery in response to the COVID-19. At the beginning of the year, the interest rates were set at 1.75%. As of March 15, they were lowered to their current level of 0.25%. Now, the Fed lowers interest rates by buying debt securities on the open market in return for newly created bank credit. The Fed is, in effect, buying government IOUs, treasury bonds, from private investors or foreign governments who have lent money to the Treasury. Flush with new reserves, the banks that the Fed buys from are able to loan money to each other at a lower Fed funds rate, which is the rate that banks lend to each other overnight. The Fed hopes that a drop in interest rates spreads throughout the financial system, reducing rates charged to businesses and individuals. And there are times when interest rates won't go any lower because, frankly, banks are nervous, so they simply hold on to their cash. In these cases, the Federal Reserve may choose to simply continue open market operations, buying bonds and other assets to flood the banking system with new credit. This is known as quantitative easing, or QE, the direct purchase of assets by the Federal Reserve to inject more money into the economy and expand the money supply. Quantitative easing usually involves a bank's central bank purchasing longer-term government bonds as well as other types of assets, such as mortgage-backed securities, or MBS. Now, the Fed has used quantitative easing on several occasions since 2008. It is not clear where the upper limit is on the Fed's ability to continue flooding trillions of new dollars into the system to protect the banks. We'll have to watch and see how this unfolds, but in the meantime, be well.